Hey everyone, welcome back to Corporate Decoder, the place where we decode those complex financial filings to bring you the real scoop. And today we're diving into Seritage Growth Properties' latest report, where it looks like they're making some interesting moves with their properties and debt. Before we jump in, if you dig getting straight insights from corporate documents without the jargon, make sure you are subscribed. We also have a Discord community linked in the description below so you can connect with other financially savvy folks. Alright, let's get into this Seritage Growth Properties. You might know them as a real estate investment trust focusing on shopping centres and then pivoting to mixed use properties. This report is a snapshot of some recent financial actions, and there is a story here about selling off assets and paying down debt. The big news here revolves around a property sale. Remember that Aventura property we heard about earlier this year? Well, it is officially sold. This transaction wrapped up on the 25th of November, 2025. Think of it like selling a big asset, a building or a piece of land, to get cash. The deal was for about $131 million. But there was a small adjustment for some unpaid leasing costs. So they sold the Aventura property and this cash is now being used for something significant. They've made a voluntary prepayment on their big senior secured term loan. This is a major financial move. They paid down $130 million of that loan. This loan was originally for $1.6 billion. And this prepayment brings the total they've paid back since December of 2021 to a massive $1.53 billion. That means only about $70 million is still outstanding on this huge loan. Now, why is this important? Because paying down debt saves you money on interest. This particular prepayment is expected to cut their annual interest costs on this loan by around $9.2 million. That's a nice chunk of change freed up that can be used elsewhere or boost their profits. It shows a clear strategy to delever, meaning to reduce their debt load significantly. The filing also includes unaudited pro forma financial statements. What this means is you get to see how the company's finances would look after this big property sale. It is a way to show investors the financial picture as if the sale had already happened before the reporting period, giving a clearer view of the company's future financial health post-transaction. It helps to understand the impact of these strategic decisions. Looking at their publicly traded securities, they have common shares and also series of cumulative redeemable preferred shares. The ticker symbols associated with these are SRG for their common stock and SRG-PAR for the preferred shares, both listed on the New York Stock Exchange. This tells us how investors can buy and sell ownership in the company and what different classes of ownership exist. While the report gives us a summary of this property sale, it also points us to more detailed documents if we want to dig super deep into the legal nitty-gritty of the purchase and sale agreement. They're essentially saying, here is the headline, but if you are a real legal eagle, the full contract is filed elsewhere for your review. Now, let's step back and look at the bigger picture for Seritage Growth Properties. On one hand, selling off assets and aggressively paying down debt is a sign of financial discipline. They are clearly focused on reducing their debt burden, which is a smart move in any economic climate. But especially when interest rates can be unpredictable, this strategy can lead to greater financial stability and potentially higher profits down the line as less money goes towards servicing debt. It suggests strong management that is willing to make tough calls to improve the company's financial foundation. However, we also need to consider what this means for their future growth. Selling properties means they have fewer operational assets. Is this part of a larger shift in their business strategy, perhaps focusing on fewer, more valuable properties, or is it a sign of retrenchment? The pro forma financials will be key here to see the impact on their overall revenue generation and profitability. It's a classic balancing act, deleveraging for safety versus maintaining growth engines. The question for investors is whether this deleveraging frees them up to invest in new opportunities or if it signals a more conservative, perhaps slower growth phase. A notable risk is always the real estate market itself. While they've sold this property, future market conditions could impact the value of their remaining assets or their ability to acquire new ones. Also, the remaining $70 million in debt, while small compared to what it was, still needs to be managed. In conclusion, Seritage Growth Properties is demonstrating a strong commitment to financial health by shedding debt. This is a fundamentally positive move that should reduce risk. The key going forward will be how they leverage this stronger financial position to drive future growth and maintain competitiveness in the real estate sector. It's a strategy that prioritizes stability, and for many investors, that's a welcome sight. Alright? That is our breakdown of Seritage Growth Properties' latest filing. What is your take on these moves and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into the corporate world. And don't forget to check out the Discord link in the description to join our growing community. Thanks for watching, and we'll see you in the next video.